Hello, good morning, good afternoon, everyone. Here we are for the session. So I'm just accepting more people to join. Um, so I think it makes sense to wait a little bit longer. I see some familiar faces, which is great. And hopefully you can hear me.
Yeah, we can hear you.
Thanks, Duarte. It feels like there's a lot of people, some I know, some I don't know. Eventually, very different profiles in the room. And I was not really sure if I would make this session a bit more complex or simpler. So I'll try to do something in between. In the meantime, I can start sharing my screen. Here it is. Okay, great. All right. Let me check if there's people waiting. Are you seeing my presentation?
Not
uh,
yet.
not
At
yet?
least, at least not me.
Yeah, it feels like there's something not right. Um, Maybe I'll switch this to a PDF, which is maybe easier. No, but the PDF, doesn't allow me to do what I want. So minute, just one more minute before I start. And while we can check if it's working. But it doesn't feel like it's working, which is annoying.
Same thing still here.
So you're not seeing anything, right, Andre?
I can see
A black
nothing.
screen only.
It's like weird striped screen. Like it's really an error.
And does it change if I change the slide?
No, but I can see your mouse moving a little bit, which is really strange.
Maybe that's because I think this is a little heavy. I'll do it in a different way. Okay, I'll do just a PDF, and probably it's not exactly the same thing, but anyway, better than nothing. Okay, so just opening. Sorry for these technical issues. more people coming in, and I think I should start now. All right, so let me share now. Hopefully this works now in PDF. So now you are seeing, right?
Still waiting for the screen to show up. It says Shilling has started screen sharing, but nothing yet. It's all black. It looks the same as before.
Okay. That's really annoying. Ah, shit.
Maybe you could try Google Meet. Usually, if one doesn't work, the other works.
Yeah, I think moving all these people to another place, it's not going to be easy. So let me do something else. I think probably it gets lighter because I think that there's one slide which is very heavy. So maybe now if I remove the slide, it gets better. No, why? Okay, it should be now, right? Not in the best setting, but anyway, I think it's better than nothing. You are seeing now, right?
Yeah,
Yes.
Finally, okay, good. Thank you. Sorry for this delay. Let me just change this. Let more people in. I think there's more people to get in. So I think now we can start. So the focus for today is managing cap tables. And I was when I was preparing this session, I was struggling a little bit how deep we should go, or I should go, or how simple. And really, it would really depend on the crowd. And I see, as I was saying, very different people that I don't know, which is great. But also people that I know that they have already some cap tables to manage. So eventually, maybe some part of this session is not so relevant for them. So sorry for them. And for the ones that don't know a lot about Shilling, I'll do a very quick introduction on us, 3 minutes, and then I'll go into the session. Please feel free to interrupt me if you'd like. It's not a very long presentation, I hope. And then I think at the end we can do some Q&A, hopefully maybe 20 to 30 minutes Q&A to maybe address some of the questions you might have, specific questions that sometimes it's easier to address and to think about. So Shilling VC, I usually say that, well, we are pioneers in Portugal. We have been around for more than 12 years now. We have been investing since 11, 12. And these are some of the oldest companies we have in the portfolio. And Bevel and Best Tables and Bizet, we invested in 2013, 2014. Best Tables was actually one of the first exits to a very large company, TripAdvisor, Barking, Coverflex, and many others. Some of them are here as well, which is great. So the point is, we have been helping and supporting entrepreneurs in Portugal, starting their companies here, and obviously scaling them elsewhere, globally, hopefully, and creating very big companies based out of Portugal. We are what we call founders to founders. The management team of Shilling at this point is 3 partners, 2 full-time, one venture partner, 1 part-time. The 3 of us founders are from a founders. So myself, an IoT founder, finance guy at Electro, an IoT cloud platform for unattended machines for the unattended markets. Pedro Carlos, our techie guy, sold his company, so former entrepreneur, created the first internet service provider in Portugal back in the 90s. and Miguel Santamar, that probably you know, serial entrepreneur on his third company now, CoverFlex CEO, and venture partner at Shilling. And what we do is a community-centric approach with a lot of people, with almost 40 or even more than 40 people that invested in the fund, from operators, advisors, founders, former founders, partners of other funds, that really want to help the Portuguese ecosystem, that really want to help us sourcing and finding the best deals, but even more importantly, to help our portfolio founders and companies on the topics on the challenge they face every day, from product to tech to go to market and marketing. And I can highlight maybe Ricardo Oliveira, that not a lot of people know in Portugal. Sold his company to Cisco 2 years ago for more than 1 billion. It's a center guy. Or Diogo Mónica, CEO of Encourage, first institutional crypto bank, more than 500 billion. Or Vasco Pedro from Embabel, or the Ricardo Vicente that led the expansion of Spotify across more than 50 markets, including US. So this is kind of the approach and the idea behind the Shilling Founders Fund, and what is Shilling is trying to position itself and try to leverage this community to add a lot of value to our community of founders and companies, and I guess overall and for the overall ecosystem. So very quickly on Shilling, then the agenda, very quick introduction to cap tables, some main concepts, then legal and valuation or value issues that can have some impact on future fundraising. That's the third point. And then some best practices / recommendations of what you should do, or at least in our perspective of what I've seen over these last more than 10 years now for me. So intro to capitalization tables. Cap table is a short name of capitalization tables, which is pretty much a legal document and basically a reflection of the ownership, the legal ownership of your company. So it's actually usually a spreadsheet where you can see all the owners of shares of the company, and also some and also if you highlight or you present that, an evolution on valuations, dilutions, new investors or new shareholders, differences between type of shares, type of rights. So that's a reflection of a lot of stuff that can be represented in a single spreadsheet of and to understand who owns, who decides, and who controls the company somehow, and who has the economic value of the company. Then one of the most important topics about building and assessing and studying scenarios in a cap table is the valuation, the pre and the post. Pre pretty much is the valuation before money coming in. Post money is actually the sum of the pre plus the money coming in, and these are two very different things. Sometimes people get a little bit confused with them, but you should always think, I think a good way to look at this, or to kind of learn more about this, is kind of seeing the Shark Tank in the US, and when they ask for a specific amount for a specific percentage or equity stake, is always thinking about post money, which means that if you take out the money coming in, then you have the pre money. Then you'll see there the ownerships. I was saying the ownerships of every shareholder, of every person in the cap table or entity in the cap table, and you can actually see over time, with the new fundraising processes, or with the new capital coming in, with the new investors coming in, how that dilution happened over time, and how and somehow the story around the equity story around the company. And finally, a very important topic: employee stock option. It's an instrument for let me just, sorry, to let some people in, which a very important instrument on a VC-backed company, which is somehow share the part of the results and the outcomes of the company to future to existing employees or to future employees, or even to attract and retain very key people in the team that are doing well, that are progressing well, that are executing well, that are creating a lot of value to the company, or that you can actually to use to hire senior people or people more experienced than you on a specific topic that you are lacking. And most of the times, these companies don't have all the resources they want to pay them on a market standard, let's say. So they use these type of instruments to incentivize them, or to incentivize these people to join and to stay longer, and actually to continue helping the company to execute and to progress over time. So these are some of the, I guess, key topics and definitions and concepts of what is a cap table. And just for the ones that don't know exactly what a cap table is, I can just quickly show some examples. So this is a typical spreadsheet economic cap table with the initial point in time when you create the company and you and the founders owned the entire company. And then here you have a scenario of 3 rounds. The first one, an angel round on a safe note with a specific cap and discount, and then the seed round where you get some extra money and you convert the previous money with a specific discount, and then the Series A. And you see here a typical and normal kind of dilution for a company that at this point after Series A would have around 54% between founders and stock option, which could be a very good scenario to have after Series A. And this you can see here, this is thinking about values in figures. So 6 million pre-money on the safe round, 750K raised on safes, post money of 6.75. Then the seed 7.5 million pre-money with the 3 million tickets would be 10.5. So these are figures and not exactly shares. But then there's always the legal cap table, which is actually the most relevant one, or the formal one, where you can actually extract values and figures and valuations to number of shares. So as you can see here, the percentages are exactly the same in every single step, but then you are not talking of value anymore, and you are talking about shares. 10,000 shares to start with for the founders, and then every single round is new shares are issued for the new investors coming in. So 2 different perspectives. A good way to start when you are not very knowledgeable of building a cap table is to always start with the economic one, much simpler, much easier to build, and then transition to a legal one with all the details of the shares. And I didn't include here the type of shares, if they are common, ordinary, or preferred, and preferred 1, 2, or 3, and so on. So just an example of what a cap table actually means. And then I think maybe some of the most, I think starting now the most relevant part of the session, which is problems, issues, constraints, things that happen over time that can create some problems for the company in the future. Starting with the legal ones. When you have a very messy cap table, very confused, not very clear, not very clean, very disorganized, it kind of creates some investors' distrust. So investors maybe can get a little bit scared and concerned that you are not actually doing a good job on having a tight and clean cap table, fully organized and really representing what is happening in the company, because it's one of the main legal documents of a company. So it creates some certain or some sort of concern that the founders don't really care or don't really know or don't really understand the impact of having it clean and tight and understandable. Then second topic, very common, it's that the typical dispersion of having many investors from many angels, many small tickets, many small investors, or even like the entire team, and then it creates some questions on how the governance is done in the company. Who makes the decisions? Who is the owner of? Who controls the decision-making process? And that can create some issues on how the company will evolve in terms of decision-making, governance, board decisions, and so on. So always great to have less investors, stronger investors, with more willingness to be involved and willingness to make decisions with the founding team, with the founders, which reflects also on voting rights. So how do you reflect? And sometimes it happens to have voting rights different than economic rights, which is a pain in the ass, and it creates a lot of confusion as well. You should try all the time to make it as simple as possible and as equal as possible between economic rights and legal rights. But sometimes it happens to have different rights, or even to give the power to others, and maybe that's like last point on legal stuff. The process, and that's really an admin stuff, but I've heard stories that I've never seen it, but I've heard stories, that crazy stories of people not willing to sign because they don't agree with something, although there's everything in writing that the company has the power, the board has the power to decide that. If there's someone not willing to sign, eventually has a problem with that. So and with more people, you have a higher chance of having problems with that. So always consider, and that's here the power of attorneys, always consider for very small investors, for very minority investors, to have some sort of power on your side to make decisions actionable and executable over time, to don't be stopped or not allowed to move forward with something that you can actually do, but for some reason you are not being able to do it. So these are some of a few examples of legal issues. Then valuation issues. So one of the things that is really impactful on a company, and I think most of the times founders, first-time founders or young founders, or founders that are starting this journey for the first time, they really care about valuation very early on. And I think sometimes they push too much, and eventually they have a very cool technology, and they are very good. And so they want to maximize valuation, minimize dilution, and all that stuff. But it can create a lot of problems in the future, because with a very high valuation, it creates a lot of pressure for the execution of the company, the execution of the milestones, and then it's difficult to see or to defend a valuation that is still higher than the previous one. It can create a not so good equity story on how the company has been evolving over time, over subsequent rounds. So previous valuation, maybe sometimes it's not so good to have a very high one or a very big one, because it can put a lot of pressure on you, on the team, to execute, and also to create future problems on future rounds. SIV conversions, always tricky, always a big mess. A lot of questions around discounts, valuation caps, maturity caps, and it's also important, even if they are not still converted, to make sure that they are reflected there, and you can reflect them there, or at least for you, when you're making your internal analysis or assessments or scenarios, include them there to see what exactly they represent in terms of dilution, and understand actually what will be the impact in terms of final outcome of a new round, even to consider how much would you raise for the next round to make something reasonable and interesting for all parties. And I think here as well, the founder incentive, and it's really important to understand it over time. You get diluted, or the founders get diluted, but the founders need to have the incentive and the feeling of ownership, and that they are still the owners and somehow the bosses of the company, the ones that are still leading the roadmap on commercial, on product, on whatever, and not feel like an employee because they own such a low amount that they feel no longer as a founder, as a relevant person in the company. So it's really important to manage these valuations, dilutions, conversions, to make sure that the founder over time sees his value improving while the dilution is happening, but still there's a good balance on that. And obviously outcomes. And ultimately, both founders and investors are looking for an exit at some point, hopefully a good exit to every party. And that creates these big outcomes, especially on the VC journey, a very big outcome that gives that everybody is happy with the outcome and financially satisfied, let's say. However, it's really, you need to be really careful about the liquidation preferences because they can really complete the game and the split of the outcomes. So it's not only about valuations and dilution, it's also about how the outcome is going to be sorted out. Because if an investor decides to invest a very high valuation, but with a 2x participating liquidation preference, that can have a very big impact on the outcome, and the cap table it still reflects the economic value, but then you need to understand that that economic value is only applicable in certain scenarios, or actually the economic value is lower because someone else is going to get first some money. So really understanding that waterfall of distributions to the shareholders, and not only the waterfall, not only the sequence, but also the amounts, and really make scenarios of what could happen in the future when you are assessing a term sheet based on this mix between valuation and for instance, liquidation preferences. And then on the team side, I include here not only the stock option investing, I'll get there, but also the founder split. And that's something that is really, I guess, more important for new founders that are incorporating now, they're creating their companies now. It's very common, especially first-time founders, to kind of split equally between the founders. And sometimes it's not the best idea to do so because you should assess and you should discuss between yourselves maybe who can have the biggest impact on the future success of the company, and maybe creating the capacity or the alignments or the incentives to make them willing to contribute more and to have more impact on the future success of the company, and have the capacity to even adjust in the future if necessary. So this is a kind of a tough question or a tough discussion to have a lot of times early on, but it's really important, and making sure that actually you have a way to get back the shares of the ones that want to leave. And this is applied to founders, but also to advisors, but also to people that you decide to let in because they believe they can add some value, but then they do nothing. So this is the last point here is the dead equity, like people or entities that have big portions of the cap table, but they don't invest money. They didn't invest money. They didn't execute anything because they left early on, or because they were supposed to contribute to something and they didn't. So this debt equity is quite a big problem when you have to manage different investors, dilutions, new raises in the future, and actually over time you need to raise 4, 5, 6, 7 rounds until you get to an exit. And every percentage is really important to make sure that everybody in the cap table is aligned and is working for the company. Obviously, founder dilution and the typical founder dilution. Just before going to the founder dilution, also on the founder split, and that's why we believe that eventually 6 founders is not the best idea, because eventually you'll get the feeling at some point that you have such a low percentage of the company that you are not feeling already still a co-founder. You feel more like an employee. So eventually you don't have incentive anymore to stay there, and you decide to leave, and then you ended up with that equity. So I guess the typical number of founders is between 2 to 4. I guess the 3 is kind of the magic number. There's no right or wrong answers, as long as you kind of create the incentives for everyone to commit, but also if they don't, the capacity to get back those shares. Founder dilution, as I was saying, really important to understand that it is a long journey. You need to raise a lot of rounds over time, and you need to have space to new investors coming in with the right terms and with the right incentives to be involved and to help. So the typical kind of 20% dilution, especially in the first rounds, that's the typical dilution you should target, and then almost you should adjust the amounts and valuations based on the 20% dilution. And only after, I don't know, Series A onward, Series B, is that where you can start seeing maybe lower dilutions, the 15 or even 10%, when you have already something like a proper business with real numbers, with real playbooks, with a great team and so on, that you can actually start asking for better terms. Just let me check the hour. Sorry, no, it's here. That's before, okay. So coming back. And stock options investing, as I mentioned, very good instrument to incentivize and to promote commitment and focus on people that you want to retain or you want to attract. Really important to make sure you have all the standard best practice of the cliffs, the vestings, making sure that if there's a bad lever, then you get back the shares. So all these things are important to make sure that you control your cap table, and you don't end in a situation with a lot of debt equity, which is a big problem for future raises. And actually, talking about that, those problems can have a really big impact on fundraising, and eventually you can have a very poor capacity to raise, or even don't raise at all, which can be a very big problem for companies. A lot of times, and we have seen a lot of times, the cap table is so messy that to make it happen, there's a recap needed to be done, with some previous investors letting go part of their shares, which is always annoying. And sometimes, it happened to us a few times, and we understand it and we accept it, but it's always annoying. And if you can avoid that, even better. So making sure that we can avoid that for previous is always great. Or then you always think about, okay, so we need to clean up the cap table. We need to maybe exit the first investors, because, well, maybe we can pay an interesting amount for them to leave. But it's also always a tough discussion, tough negotiations. I've seen a few times that sometimes the expectation is there, but then on the founder side, but then on the investor side, it's not, because they see another investor coming in, so they see added value or increased valuation. So why to leave now when things seem to go well, or at least there's people coming in with a higher valuation? So always very difficult to do secondary deals in those circumstances. Obviously, if there's a an oversubscribed round, then it's easier to get some secondary. Although the typical secondaries of oversubscribed rounds is for the founders to give them some money because they have a lot of paper money but not a lot of actual money. And similar to buyback deals, when you start negotiating to get back some stake, it can be a kind of a pain in the ass, those negotiations, that feeling of eventually you're leaving some money on the table, and maybe you can accept it but not very happy. So it creates some tension and somehow some fights. So if you can avoid that, even better, obviously. And finally, best practices to wrap it up. Keep it simple and clean. Obviously, money is money, and when there's not a lot of options, you need to raise whatever you can. But try always to maximize for having the right partners on your side. Not a lot of them. Options, capacity to choose between the ones you like the most. Sorry, there's one people coming in. So avoid too much dispersion for governance stuff, for signature stuff, for even investor relations stuff. It's much easier to manage three or four investors than manage 20. Even if because even the angels that are not so formal and institutional, they still want to know how things are evolving. They want still they still want to have some feedback and some ideas of where they can help or how things are going, or just to ask you for information which creates some additional work to you. So if you can avoid dispersion, that's great. There's this 50% rule, if possible. That's great to have ownership of over 50% after Series A. I mean, the founders and stock option. That's a great position to be. So try to create a story over time with the money you raise to make sure or to maximize the likelihood or the chances of having over 50% after Series A. Simulate different scenarios on valuations, on safes, on stock options, on liquidation preferences. Important to understand the impact of different scenarios, different investors, different types of instruments. Important to understand those impacts. And finally, one thing that is not so related to cap tables per se, but still important, try to make sure that you have standard preferred rights on the governance side, on the voting side, on the liquidation side, on the drags and tags alongs. That can have impact on the governance, but also on the outcomes, on the split of the outcomes. So make sure that it's better to have standard preferred rights with a lower valuation than having something much higher, but then crazy governance, crazy investors, crazy stuff going on. So I would say that at least I think that's our view on that. I'm not sure, but I think we are supposed to send this presentation afterwards. So there's a few links and content that you can ask. There's a lot of information online. You can just manage cap table and so on. You will find a lot of stuff. And I stop here. So yeah, and so I stop sharing So I have here the master of cap tables. I see now, Luis. So he's the one. He should be the one doing this session, not me. But anyway.
Shamefully, I got in 2 minutes ago. Shamefully.
No, fortunately for me.
Sorry
Anyway,
about
so this was my presentation, a bit longer than I was expecting. Anyway, I think maybe a little bit longer than or over 30 minutes. But I guess it's always difficult to think about a lot of scenarios and ideas. So if you want to kind of shoot some questions, I think that's the time to do so. Luis, you are not allowed to make questions. Your questions are way too complex to me.
I would never do that, Ricardo. Shamefully, shamefully.
Maybe if you want to like share maybe situations you saw in the past with even, or you can somehow disguise your situations with a scenario that you saw with a friend and address. Yeah, Rodrigo?
Hello, can I go?
Sure, Rodrigo. Yes.
So I have one question that is how to manage a cap table around Series A if you're like thinking like maybe this can be a cash positive business. So because most of the cases you're thinking is like for future growth stage or future rounds. And my question is how to optimize it with maybe secondaries in mind or maybe profitability in mind. So how to optimize in that scenario.
Rodrigo, that's a great question. I think that question is maybe more related to a not so much VC-backed company, which is perfectly fine. And I think in those scenarios, I would say that the most important thing that you need to have on your cap table, I guess that's kind of a reflection, but among your investors or shareholders is alignment, in making sure that everybody is there with the same goal, with the same timeline, and with the same kind of milestones. So if you have a VC there, at some point they will ask you to leave. And that could be an opportunity for you because maybe they are willing to leave. Maybe you are no longer their like the best case in the portfolios or the top performers. So they actually are willing to leave at getting back the money. And that's kind of the buyback I was talking about over the session. Or you can even, if you have investors like angels or more, maybe less VC, more long-term investors, maybe corporates or whatever, then you can even think, okay, we are making cash. If someone wants to leave, we can use that cash to pay back those shares and give the capacity to give an exit to them, or we can just start paying dividends to them. So I think that's a good place to be as long as everyone is aligned with the strategy and objectives. So I would say that making sure maybe talk to all those guys, or even raise to find investors that are more aligned with your vision, with the stage of the company or with the strategy of the company, and kind of replace kind of a secondary deal. Instead of you buying back with the money from the company, you can use someone else's money to do a secondary deal and give an exit to the ones that are not so aligned, that want an exit but you don't want an exit, and then have someone alongside you that are more aligned with you. I don't know if I replied, Rodrigo.
Yes, thanks.
All right. So I think there was a question from Bruno. Well, can you go over the difference between economic and legal cap tables? Well, the outcome should be the same, right? I think when I do my quick calculations, I always like to do them on kind of the economic perspective because it's much easier to do. Like there's a pre-money valuation. The pre-money valuation should be applied to existing shareholders with their own stakes, with their specific stakes, and then you know exactly the amount or the value of your ownership, and then you just add on the additional money, and then you have the post money, and then you compile or you calculate the ownerships based on the pre-money valuation, split it the existing shareholders and the new money coming in. But that's not actually the formal and the official cap table. It's just a simpler way to look at it. Then you need to put that in shares, in shareholdings, in quotas, whatever the company is, and that it should be exactly the same, but in two different perspectives. And I think it's always easier to understand. Maybe I think it's always easier to understand with economic value. And then if you agree with the economic value of a specific offer, then you can just ask or you can just calculate the legal cap table. Usually lawyers, correct me if I'm wrong, Luis, but lawyers are supposed to do that migration between economic to legal.
Ideally, yes. Sometimes there's a bit of a mismatch, but ideally, yes.
Right. So
Because-
that's Bruno's question. Hopefully I got it.
Sorry.
Bruno,
Can-
sorry, you said
Yeah. So the economic cap table could always be derived from the economic cap table could always be derived from the legal cap table, right? Once
and the
you
other way
agree on a
around.
price per share.
It's yeah, exactly. If you have a
Okay,
price per
got
share,
it.
it's exactly yeah.
Okay, got it. Thanks.
There-
Depends who you're asking. If you're asking the lawyer, he will say legal to economic. If you're gonna ask
Of
the
course.
guy, he's gonna
Yeah.
say the other way around.
But as soon as you agree on a share price, you can replace one with the other
Yeah, absolutely.
most
Absolutely.
trivially.
Absolutely.
Okay, thank you. Got it.
They are exactly the same, just different perspectives. That's it. Richard Griffiths, you've talked about best practices or what you prefer to see in the cap table, but do you have any examples of companies you have evaluated that you have rejected purely on red flags? You have seen in the cap table, yes. Debt equity. We are just seeing a company now. Duarte from my team is here. We are just seeing a company now that the CEO left and still has 15% or something. So the CEO has 15%, is no longer there or she's no longer there. And then we have kind of a big problem. So I'm not even, and there's a new CEO, but it was not a co-founder, as a very small stake. It should be completely the other way around, but it's not. And we are saying to them, look, we are not investing in a situation like this. That's an example of that. Another example, when the founders get too diluted too early. Actually, a cap table could be a limitation for a very big outcome, because if the founders have too little of a percentage after seed round, they have 40% after seed round. That's very difficult to make sure that they can still raise Series A, Series B, Series C, Series D without going into 5% each to maybe, let's say, 10% in total. They completely feel like employees and no longer. And they have so limited power in the company that they actually can be just forced out by the other shareholders to put someone else there, like a new CEO or a new management team. So early on to have a very small stake can be I've rejected companies on that situation. And usually what happens is that we try to do a recap, like increasing significantly the stock option only funded by the investors, not by the team, or funded by everyone, but allocating half of the new stock option increase to the founders. So kind of doing the same thing, but in a different way. Or to try to buy those shares for a small amount, because investors so early on don't like so much to see exits going on, because all the money that should come in is to execute on a plan and not to give some exits to investors. So yeah, those for instance are debt equity, too much dilution, wrong equity splits between founders. I've seen that as well. Like the CEO has 1/3 of the other founder, and the other founder is really important, really great, and we understand. We can even understand why, but it does make sense to have such a difference between the CEO and the CTO, for instance, that with 1/3 of the CTO. That's a little bit strange to have a CEO that is supposed to have all the relationships with investors and kind of do the fundraising process, to have such a low amount. So that's also a good example of a situation that we saw, and we kind of decided to not move forward. Andre, so hopefully, Richard, I've answered. So Andre, what are the top 3 reasons why early minority investors that have veto powers block new rounds or secondaries later on? Top 3 reasons why early minority investors minority, I guess, minority meaning institutionals or angels. Because if it's an angel, they should have a veto right, I think. So minorities, but still the institutions or the ones that were leading the previous rounds. Block new rounds. I think conflicts between the different shareholders, the conflicts between the investors and the founders. I think that could be a good reason why to block. Or very different strategies and alignments between shareholders. I'm to be completely honest, it was not a secondary deal, it was an exit, but the exit was not very interesting for the investors, and even it was even worse because it was an exit with different terms for different shareholders. So the founders would have kind of a double valuation, but these guys with a new round. It was very clear that the investors were kind of were being treated not in a very proper way, I guess, or correct way, and it was kind of a reason why to block, because it was not the right way to try to execute an exit for the investors. I didn't see a lot of situations like that, but I would say that some of these are maybe common reasons why. I don't know, Luis, you have seen much more than me, so no, it's true, you are a lawyer, I'm not, so you are doing deals all the time, so.
Yeah, but I don't have much to add to that, Ricardo. That's probably what I would say, that it's what I see the most. That's probably it, Ricardo. I would not have much to add there. Unfortunately, I would love to say something clever, but
all right. You have a few
Can I jump in, Ricardo? I think one of the reasons.
Let's go,
sorry.
That's the other full-time partner I mentioned in the beginning.
I can imagine one reason being a very industry-specific investor. I mean, an industry player coming into the companies too soon, making it very difficult for the company to get new rounds of investment from normal VC funds would be a reason why you would block an investment round from let's say an industry player in a way that it would create some difficulty in raising further rounds.
All right, thanks, Pedro. So Andre, I will move forward. So Miguel Vieira, 2 questions. What are the best practices for founder equity dilution in an investment round? And second, what are the best / common practices to buy back equity from a founder that don't execute? First one, I think it's easier. I guess very early on, I guess you should always think about 20% dilution in every single round. And it's funny. A lot of people ask us, how do you calculate your valuations? And it's very simple. We do it. It's pretty much looking at. We always consider the 20% dilution on average, but let's focus on the 20%. We look at the amount the company is raising, and then we look at the stage of the company. And if it's a pre-seed, there's no traction, there's no metrics, there's nothing to kind of look at. It's only kind of the team, the quality of the team, the knowledge of the team, and the size of the markets. Then I think we adjust the valuation, or we just the valuation and the round, depending on the quality of the team and if it's a big market or maybe not so big. And that's the way we kind of calculate the valuations. If it is kind of a Series A, then you kind of do, I guess, more or less the same math, but then you kind of double check with multiples. So these guys are doing 1 million in ARR. They're asking for a round which has an implied multiple on revenue of 10x. Okay, 10x seems reasonable for the past traction or the past evolution, and the market seems good enough. that's good. Or it's 30x, and maybe 30x, it has to be like the best thing in the world, like crazy market. And then I think it's much, I think, so 30x, I would say it's very difficult right now, especially right now on Series A, to raise at the 30x multiple. It had to be kind of the last thing in the world. For the second one, what are the best common practices to buy back equity? I guess that's kind of a negotiation process, and it's very difficult to do it if you don't have some sort of agreement beforehand. And if you are going to buy back based on execution, it's a very subjective topic, and they can say I'm executing to perfection, and you can say I don't agree. So then it's very complicated discussion to have on execution. If it is, he did something completely wrong because I don't know, he left the company, he doesn't do anything, he decided to work to other company, he decided to take another career, whatever, then I think it's easier to have that discussion. But I would say, and it's very uncommon to see those type of agreements between founders, but it's always great to have some sort of agreement between founders, even before the new the angels or the investors coming in, because it feels like that then they understand the problems of, or future problems that can happen, or situations that can happen, and you try already to address them beforehand, which is a great sign that you actually worry about that and you are concerned about that, and you're actually trying to find some formulas to mitigate those risks if they happen. So great to have something beforehand, kind of pre-agreed. If you don't have nothing, I think it's always a matter of, I've seen a few situations like that, some very, very difficult, others very, very easy, because everybody on the easy ones, everybody was pretty much reasonable and understood the situation, and there was a good argument and a good negotiation and a good outcome. In the bad cases, sometimes it can go to a legal process, to a court process. I'm remembering one that I didn't follow that much, but I know it was a painful process, and it took a few years until it was closed. But it was a very messy one, because there were no kind of agreements, and they were kind of fighting against each other. So, and that one, actually, the founder that left to work in a competitor. So it was kind of an easy one, but still, it was a tough one to discuss and negotiate. Hopefully I answered it.
Yes, thank you.
Miguel.
Yeah, thank you.
Sami, what are your thoughts on longer expiration employee stock options? I've seen 7 or 8 years instead of the standard 90 days. Longer expiration for employee stock options. Sami, can you help me here? Longer expiration.
Yeah, so after employees are no longer with the company, most startups have a 90-day expiration of the right to exercise stock options for employees. But I have seen a few startups sort of more recently going to longer expiration post end of employment. That's, what I've seen 7 or 10 years.
Yeah, to buy back.
Yeah, not to buy, to exercise the option.
Oh, okay. To be honest, was this here in Portugal, Sami?
No, this is in the US, Silicon Valley.
Oh yeah, I guess so, because I think it's there was a big change in regulation, I think 1 or 2 years ago on the stock option side. I think it was an improvement. But to be honest, I think I didn't see a lot of situations like this happening in Portugal. I think it's still early days for us in this matter. So maybe I would ask, actually, Luis, as you are here, if you can. This is very legal for me, to be honest.
No, I can. 90 days come from legal provisions in the US. So if you don't have the 90-day window after you've left the company to exercise, you will not be eligible for the tax favorable regime in the US. That's why it's back to the 90 days. If you don't have that legal regime, companies are becoming a bit more employee friendly, and mainly because of the not optional campaign that Index Ventures put forward and try to be more employee friendly and having a bigger window to exercise. That was something that we're pushing for. So where you don't have that imposed by law, you pretty much have leeway to do that. And we're seeing it get extended, to be fair. Don't know if that.
Thank you. Yes, that covers it. I know you lose the tax friendliness benefit actually even right now in the US, but yeah, I was wondering if there are any cap table implications or concerns if you see an options pool that allows employees who have left the company long ago to still exercise.
If you have it for very long periods, you're going to have you will not replenish your stock option plan as swiftly, so that can have an implication on you having to top it up more frequently. But that's just it. I think Ricardo, nobody will say that there's an issue in itself. It's just may entail a bigger top up.
Yeah, got it. Okay, thank you very much.
All right, I think no further questions from you guys, at least on the chat, and I think no one has their hand raised. So actually, it was supposed to be 1 hour. It's pretty much there. So if no other questions, I guess so. I would wrap it up. Thank you so much for attending. Hopefully, it was interesting enough to be here for the full hour. And if you have my contacts, you can always reach out, and we can try to help if you can. If we can't, we can try to give you some guidance of who you should talk to, for instance, Luis or all the great lawyers we have in Portugal. Thank you, guys.
Thank you. Bye.
Bye-bye.